The November jobs report was released Friday morning, and while the unemployment rate held steady at 3.7%, 155,000 jobs were added to the economy in November. That was lower than the expected number of 200,000. What does it show us about growth right now, and should we be concerned? The global head of investment for Citi Private Bank, David Bailin, joins me right now to talk more about that. David, it's good to see you. Thanks so much for joining us this weekend. Your reaction to the November jobs report. Let's start there.
Yeah, I think it was a decent jobs report, and as you said, it has certain advantages, which it suggests that the economy is not overheating and things aren't going crazy. If you look beyond the headline number, you basically can see that the jobs growth was good, but also the people returning to the workforce was good. And wages were modestly up, pretty much consistent at 3% year over year, which is the kind of wage growth I think that is in everyone's sight. So I would describe it as a good report, not particularly disappointing, and not necessarily going to make the Fed do one thing or another.
So the big issues for this market right now have been interest rates. We saw the markets trade wildly this past week as the 10-year yield dropped below 3%. It's above that right now. You've also got the issue over China and these trade talks, steel and aluminum tariffs and the trade issues. Tell us what's most important from your standpoint in terms of the stock market and how to invest in 2019.
Well, that's exactly. We're in the process right now at Citi Private Bank of going through our Outlook 2019, and there are three key themes that we're focused on. One is making your cash work harder, and we saw investors do that this week. You saw the short end of the curve do extraordinarily well, and our largest overweight happens to be in short duration treasuries, where people are getting paid a lot of money, for short duration fixed income. Over the course of the year, we think that rates are going to continue to rise, and we also think that the Fed is going to have a pretty consistent path, which is why, to answer one of your earlier points, it's important for people to understand that it's a year out. We don't know what the Fed's going to do, but it's probably unrealistic to expect that they're not going to raise rates 2, 3, or 4 more times over the course of that year, which means that investors by the end of the year will be able to extend duration on their portfolios. So that's our expectation there, and making your cash work harder is really important.
Sorry, go ahead.
No, to answer your question about what investors should be worried about, it's really all about earnings, and no one is talking about them. Our expectations for next year is that in the U.S., earnings will be up 8%. Overseas, earnings are going to be up 8%. And we think that equities by the end of next year will be up 7 to 8%. And that's really at the core of what we're doing. The question is, can investors tolerate the volatility that goes on day to day?
Yeah, and I know that you are expecting a slowdown on a global basis. But, you mentioned earnings. I mean, we just came off of the third quarter, where third quarter profits were up 29%. What a great number, 29%. I know some of that was the tax cut plan. Now you're talking about 8% profit growth in 2019. Maybe that's what's scaring investors. That's a big drop-off, 29% profit growth to 8% overall. Why are we seeing such a drop-off in profits?
Well, I want to sort of put this in context for all of the people you're watching, which is that this year, if you were to look over the course of the year, let's say earnings are up 21, 22% on average. 8% of that is the tax bill itself, which is a one-time event. So you take that out and you end up with 12 or 13%. So we're going from 12 or 13 in my mind to a normalized 8, and that actually is particularly good because the economy doesn't sustain the jolt of tax spending, for a long time. The other thing that's driving growth in the U.S. is our growth of EPS, our share repurchases, increased dividends, things that are really being done that benefit investors. And those things are also driving the U.S. market. So while it may not seem exciting, given what the last 10 years have looked like, if you're up 8% next year, dividends included or more, I think you've had a particularly good run, especially given the underperformance we saw in 2018.
All right, we will leave it there. David, always a pleasure to see you. Thanks so much.